Starwood Hotels and Resorts, the owner of the St. Regis and the W hotel brands, beat fourth quarter earnings estimates on cost cuts and asset sales. The stock is up more than 5% on the news. Bloomberg's Bertran joins me now with Starwood CFO Vasant Prabhu. Monica?
Mark, thanks so much. Vasant, thanks for joining us. Let me get your sense about what's happening with the hotel business. Now, you over at Starwood have increased your targets for 2010 on RevPAR, which they call revenue per available room. Why is that when there's really no visibility in terms of the economy?
Well, the big story about the fourth quarter was the business travelers back. We saw some significant change in our trends. Corporate business, the business traveler who shows up a couple of nights ahead of time without a lot of lead time, came back in a big way. We saw some significant changes in trend. We saw in Asia, for example, we were down 10% in October. We were up 10% in January, a 20-point swing. So that's the big story. And so as a result of that, we felt that we think next year now is going to be a growth year for us.
Now, you talk about the business traveler, very important because they're probably paying at a higher rate. I want to get to rates in a moment, but what about the leisure traveler? Are they back yet?
In fact, the leisure traveler came back in the summer. We started to see leisure business pick up in the summer. The leisure traveler was actually in our hotels in the fourth quarter too. In December, in New York, for example, our occupancies were over 88%, which, by the way, was as high as it was in 2007 at the peak. So the leisure traveler is alive and well. People are out there traveling again. But the big news is that corporate America, and in fact corporations around the world, have decided it's time to get back on the road, start selling, motivating their people. And that's good news not just for us, but for the economy as a whole.
Let's talk about pricing, though. They may be back, but are they paying the premium prices?
Well, they have better deals. You should all be coming. We have cut rates. Unfortunately, over the last couple of years, we've seen rates drop. So this is the way it always works in our business. It's occupancies, as we call them, coming back first. As hotels start to fill up, we start raising rates again. But rates are now quite a bit lower than they used to be. So it's a good time to travel.
Well, when will you be able to start raising rates? I mean, what kind of numbers do you need to see?
Well, this is the way it always happens. Our occupancies drop into the 50s and 60s, then they start coming back. And as occupancies get into the 70s, we start to get the ability to raise rates. It's the mix of business. We like having midweek travel. That's the business that normally pays more. So the quality of business is improving, and so we start to see our ability to improve rates. So for example, rates are still down, but they're less down than they used to be. So things are still good from a traveler standpoint, but in about 6 months or a year, you're going to start seeing rates climb up again.
What about in New York in particular? You're talking about 80% occupancy rates in New York, so you're able to raise prices here and other pockets?
Yeah, what we're going to see is rates becoming less negative. So while rates will still be below where they were in 2007 and early 2008, they're certainly down less than they were a year ago. So that's improving.
Let's turn to China, because the plans for China to increase over a quarter of new hotels in China in particular. Are there any markets that you're trying to get out of in the past year, considering what's happening? I know that China's strong, but are there any markets that are weaker that you're talking about maybe pulling back from?
In fact, we are not exiting any markets. China is a very big market for us. Sheraton is one of our best-known brands around the world. We have 50 hotels in China, going to 100. We are thrilled with the quality of our business in China, the growth in China. In fact, around the world, what we see is a significant amount of infrastructure building, middle class is growing, wealth increasing. We're starting to see extraordinary amounts of hotel construction over the past several years. So we are very excited about growth almost everywhere. There's almost no market in the world today we would say we don't want to be in. This is a growth industry.
Now, on the conference call, in this statement, it was quoted that this is not the best time to be selling assets. You have shed some assets, so is it a good time to be buying assets? And when is it going to be a good time? Do you have to get rid of some more?
Well, we are moving down the track of selling hotels we own. We selectively sold a few things. We call them non-core assets. We sold a spa business we owned, Bliss. We sold some retail shops we had on Fifth Avenue. We did that. We got some extraordinary prices. But in general, we don't think this is the best time to be selling hotels. We would be looking at hotels, not necessarily to buy on our own, because we don't expect to be big owners of hotels, but we'll partner with people. There are other people we work with, our owners. We would buy hotels with them, and that would be our game plan.
All right, we have to leave it there. Vasant Prabhu, thanks so much.